All right. I want to talk about this. Tough times never last, but tough people do. I feel like that's a perfect thing to discuss as we go into the new year, right?
Is that reflected onto the ceiling above your bed when your alarm goes off?
Yes. Yep. Absolutely. All right. I'm going to start to share my screen. I'm going to hand it off to you, Rob. Let me get this going.
It is always interesting as you come to the end of the year to talk about the next year. And I think that we've got a great team here to do that. And we're really going to get into the nuts and bolts and also take a big picture view of things. But let's talk about how it's been an amazing 3 years at this point, 2020, 2021, followed by 2022. I think everybody on the call probably knew deep inside that 30-year rates wouldn't be at 2 3/4 for the rest of their lives, and that we would be suffering a hangover. Nobody probably predicted the hangover that the industry's been through. But I wanted to dive right in with some introductions, and as I said, I think we've got a good team to talk about the end of this year and into 2023. Alex, obviously everybody on the call knows who you are, the chief visionary officer of Sales Boomerang and MortgageCoach. When I was growing up, there were plain old titles like CEO, president, things like this. There weren't chief visionary officers. But besides that brief introduction, Alex, I wanted you to tell the audience one little snippet of something that most people don't know about you.
One little snippet that they don't know about me. I'm going to go with the fact that I can walk on my hands for minutes at a time, just until I get tired. I could just, if I didn't get tired, if my arms didn't get tired, I'd just keep going. But I can walk for minutes at a time on my hands.
Okay, the gauntlet has been thrown down. The next conference I see you at, look out.
I'm ready. Anytime.
Next up, Dave Savage, Chief Innovation Officer for MortgageCoach and Sales Boomerang. Dave, welcome. And what's a little snippet about you that people don't know about?
People close to me probably know about it, but I tied flies through high school, wanted to be a fly fishing guide, and used to be a fly fishing guide in Wyoming through college.
Nice. Adam's aunt, all that kind of stuff. Very good.
And anybody that does want, me to guide a trip or anything, Vimeo, shoot me a text or email and I'll let you know how to pay me.
All right. We won't go down that rabbit hole, I'll tell you. Next up, Dr. Michael Fratantoni. So if anybody has not met Mike in a hallway, don't call him. He goes by Sir or Dr. Fratantoni. Don't call him Mike. I've only been able to do that in recent months, but obviously the chief economist, fabled chief economist of the MBA. That's how I always list him in my commentary. And he's been with the Mortgage Bankers Association for several years. And I in all seriousness, I respect Mike and I like him a lot, and think that some of his forecasts have actually come true. So that's high praise. Mike, I'll ask the same question of you, a little snippet about something that people don't know about you.
Let me just contradict Rob. Call me Mike whenever you want. I really enjoy cooking for Thanksgiving. Prefer to grill a turkey, and I've grilled a 22-pound turkey on my little charcoal grill. So that's something I'm pretty proud of.
Holy smokes!
Exactly right.
That's exactly right.
on the hibachi of your 2-bedroom, 1-bath walk-up apartment in Georgetown. All right. And I'm Rob Chrisman. I get to moderate today's session, and let's jump in.
Whoa, Rob, we don't get a little factoid about you, little personal note, please?
A little factoid about myself is
that we might not know.
That my goal has become to have you guide me on a fly fishing trip, because the last guided fly fishing trip I went on was in Patagonia and did very well. But Dave, to be guided on a trip with you, I think would be the pinnacle of my fishing career. So
We'll get it
I'm
on the
gonna
schedule. Can't wait.
I am gonna hit you up for that. All right, enough lighthearted banter. We're gonna start with a polling question for everybody. And if you can't read, I'm sorry to hear that, but has your business made the necessary changes to survive? There is a tremendous amount going on out there in terms of changes. Click the yes and the no. And it's when you get together with folks at conferences, and I have had the privilege of doing some traveling in recent months to places like Florida and Wisconsin, Minnesota, Chicago, Southern California, Northern California, lots of places. Change, we're dealing with an industry that's always changing. But as I tell people, it's nice to have Fannie Mae or Freddie Mac make a 5-year plan or a 3-year plan. But if you're looking to just survive the next 3 months or 5 months, it doesn't matter what Fannie Mae is doing 5 years out. So this question here is very relevant. Have you made the necessary changes? And Alex, do we have the results yet?
Yeah, we're about to post them right now.
All right.
Let's see. Yes.
That's very good. That's very good. I had noted in my commentary today in the opening sentences about how it seems like some companies are caught in the surf. Anybody who's been swimming in the ocean knows that you don't want to spend too much time in the waves. You either swim out beyond the waves or you stay on the beach. And it seems like a lot of companies right now are getting caught in the churn, and that's not a good place to be. So I'm glad to see the yes as the predominant answer to that. So then the question, of course, is, have rates reached their peak? And I know I'm going to actually throw this open to the group, and I will chime in first by saying or Alex, is this actually a polling question? Should we
No, this one is a question to discuss. I think this is just for us to jump into.
Just for us. Well, I will jump in and say that I think rates have peaked. I've been telling people that for a month or two now, that it just doesn't seem like rates are going to head higher. I know Mike has some great slides coming up to discuss this idea, but I just am more of a behavioral economist. I kind of look around at what's going on around me, and it seems like the economy, I don't see it heading for a recession either, which would really drive rates lower, but I don't see it churning well enough to push rates higher. So I think we could just kind of waffle around this area for most of 2023. Alex, what are you hearing out there? What are you thinking out there?
Yeah, so from what I've seen, I agree with you, Rob, that I believe it has reached the peak and it's starting to plateau and maybe move down. I'm excited to see later in the presentation, Dr. Michael is going to be showing us some real details on this. But from my perspective, from reading, from seeing what's happening in the markets, from sort of understanding where this country has to go, I do believe we've hit a plateau. I'll throw the baton over to Dave and see where his thoughts are.
Well, I'm looking forward to hearing from Sir Michael, but I do believe rates have peaked, and for the people I listen to, Dan Rovich and our mortgage coach community and other folks that have an opinion, yeah, they've peaked, but we'll know what's really going on in a few minutes. I would encourage anyone, we'd love to know if you're a loan officer, if you're a leader of a mortgage company, what do you think? Put that in chat.
Yes.
Mike,
any quick thoughts before we move on from this?
Yeah, like Rob was indicating, I'll really hold my thoughts till I got my pictures in front of you, but I agree with you guys that I think we're past the peak. We were between 7 and 7.5. Last I looked today, we're at 6.25. So we think it's likely to go lower from here over the course of the next year. Boy, the day-to-day volatility is something though. So I have much less confidence over the next week than I do over the next year.
And by the way, real quick, Rob, and if you do look at chat, everyone seems to agree also. Everyone seems to be like, yes, this is hit that level for us. We're getting some thumbs up from people. Keep using those reactions, guys. I'm going to go back to sharing the screen, and we can get back into this because we did just, oh, I love it. Everyone's giving some thumbs up here.
So let me interject, Alex. There's an old story about Joseph Kennedy. Boy, I'm going to butcher this story dramatically, but Joseph Kennedy is supposedly on his way to the stock exchange before the Depression hits, and he's getting his shoe shined by a shoe shine boy. And he asked the shoe shine boy, "Hey, which way is the market going?" And the shoe shine boy has an opinion about which way the stock market is going. And supposedly Joseph Kennedy at that point thought to himself, "Boy, if shoe shine boys are giving me stock picks, I need to get out of this market," and got out of the market. I hope that everybody on the call is actually right, and that we're not listening to shoe shine boys give interest rate projections. So with that being said, I think it's important also for folks on the call to know that a mortgage company and a vendor sells product, price, and service. And so we can talk about price all we want, but when you talk about products and service, I think that's where a lot of companies will differentiate themselves. And I'm glad, Alex, that you and Dave are on the call here and can address some of those product and service issues and help originators to complete the picture.
Oh, yes, most definitely. And by the way, I think it's worth noting here that, first of all, the audience is involved big time. So highly appreciate that. And Carl says it's hard to predict. He makes a very good point. He says it's hard to predict because who would have ever guessed we'd get to 7%? So here's your great story of the shoe shine boy. Like, are we really taking that advice, or it's too hard to predict? Let's keep our heads down. So it's interesting. Thank you, Carl, and all of you for that feedback there. Should I just keep going here, Rob, since this section
Absolutely. Yeah.
Awesome. So look, everyone, what I want to do right now is I want to show you, as you all know, since 2017, as a borrower intelligence company, we've been looking at existing databases within the lending industry, banks, credit unions, mortgage lenders, independents, that, hey, what is happening in your database, which is not just your funded deals, it's your funded deals, it's your pipeline, it's the people you've turned down, it's your leads and prospects you're talking to at the moment and trying to get them to engage. So your entire database, how active is it versus the open market? What's happening within compared to what's happening outside in the open market and what you're seeing? And so the numbers you're seeing here right now represent nearly 14 million records from hundreds of lenders that we manage their mortgages for them, their database. And this is the activity that's happening within those nearly 14 million records and hundreds of lenders. Why is this relevant to you that's watching? What's important to you is to understand what is happening within the people that you've been in contact with. We have amazing partners who tell us all the time, and I'm sure you guys, and I'd love to hear from Rob and Mike on this, but everyone's saying, hey, 2020, 2021, specifically 21, all of the people that we've done loans for, and all the ones that we're doing loans for at this higher rate, right, are going to be mortgage customers again, possibly 2 or 3 times in the next 2 or 3 years. And so why is this important? Because everyone you've ingested, everyone you're speaking to, everyone you've been in contact with over the last year or two, depending on what you've done with them, is going to be active again. But how active? And so what you're seeing here is, and I'll just give you a quick nuance and I'll move on to the next slide, is nearly 1%, right? So 1 in 100 of people in your database today are shopping for a mortgage every single month, okay? Nearly a 0.3% of your database is triggering an early payoff. You guys need to know that. That number was much higher in previous years, if you remember us sharing this data. And now you understand how to read this database, how to read this spreadsheet. And so, credit improvement, what's that mean? It means you have people in your database, nearly 2% of the people in your database are going to be improving their credit position every 30 days, every month. This is from the last 30 days. Of course, we've been tracking this every month for the year, but this is the last 30 days. So you guys know this isn't like from the last 12 months. So we're keeping it really relevant and timely. And so now you're seeing your database. So it's important to understand there's activity, there's real activity. And to be blind to it means you can't really serve the market the way you're supposed to serve it. And you have to go hunting. There's a great phrase out there, great thought out there that says a hunter can feed a family, but a farmer can feed a village. So if you learn how to farm the opportunities, the people, the customers, the relationships, the referrals you have, you're going to generate a lot more opportunity. You're going to be able to feed your entire team over time, over and over and over again. Okay. Let me, unless there's comments, I'm going to jump to the next screen. Any thoughts or comments from the audience? I mean, from the panel? No. All right. I'll just jump in, keep going. I'll check in on chat. I see chat's going crazy here. I'll check in on that in just a second. We also wanted to show you all a real snapshot. This is a real organization that's got 47,181 records within the platform. And this is what their system produced for them in a 30-day period. This is just November. So with 47,000 records, this organization was able to generate 4,700 opportunities from their database, the opportunities you saw right here. That's what they were able to do for themselves in 1 month. It's very important to understand the power of this borrower intelligence, the power of knowing the activities and the needs of your customers. Right now, we know that most organizations are like, I need to find good people to talk to. I need to find relevant conversations. Dave and I were on a call the other day with Dale, who's talking about, hey, 2022 was conversion year, not volume year. 23 is going to be conversion year again, meaning you need to know the customers, how to position yourself, how to present yourself. And so just giving you guys a quick snapshot, if there's any questions out there of, hey, we're always hunting, we're always looking for new. Sometimes if you turn it around and look within, you may find that you have a lot more people that want your service right now, and there's less convincing, less proving, just a much easier conversation to have with the existing database. So the reason we wanted to show you this is it's not dead out there, right? There's real activity, there's real people looking for real mortgage solutions, and you should not be blind to it. Okay, so let me stop for a second. Any
Alex,
thoughts on
jump
this?
in.
Yeah.
The one thought I wanted to share on it, because I interviewed Mitch Kiter on Friday, but it was actually released into our YouTube channel on Monday. And one of the key components, I mean, he shared, hey, what are the top compliance concerns coming into 2023? So we'll put a link to that in chat. It's like a 30-minute interview with Mitch Kiter, but
Good.
There was alignment around data is critical, guys. The lender of the future. I've said it, I think, years ago on stage. Technology is not going to eliminate loan officers, but what I will say from a lot of stages this year, data-driven mortgage advisors are already taking market share from lenders and loan officers that won't. So if you want to kill it in 23, data-driven mortgage advisors are the way to go. So I know we want to hear from Rob, and we want to hear the update from Mike. So that's all I have to say there.
Perfect. Okay. Rob, I'll hand it to you. Go from here.
Well, but I'm just I'm giving a boost to Mike here. As I mentioned earlier, Mike is the fabled chief economist with the MBA, and I will tell you a quick highlight of my life, which will be maybe replaced by fishing with Dave next year. But I remember one time several years ago, Mike might not even know this. I was sitting there we were at a conference. I don't know. I was at a conference and I was doing the exercise bicycle, and I'm reading the Wall Street Journal, and I flipped to some page of it, and the MBA's application data is in the Wall Street Journal, and there's a quote by Dr. Michael Fratantoni, and I'm reading it, and I look up, and there is the man, the myth, on the Stairmaster, like 20 feet away from me, and I'm reading this guy's name in the Wall Street Journal, and there he is 20 feet away. I thought, oh my gosh, this is the big leagues. It was an amazing experience. Had to have been there.
You felt like you've made it.
Yeah. Anyway, Mike, you've got a lot to talk about here. So I know a lot of people are waiting for your words, so I'm not going to delay anymore. But I think it's important for people on the call. It's nice to have an opinion about rates are going, but it's important more so that when your client comes to you and wants some kind of information about, maybe you're a loan officer and the client is on the fence, like, oh, I hear rates are going to do this or rates are going to do that. It's important to give that client information about why rates might do what
Yes.
they do. And that's what Mike is about to do here.
Yeah. Thanks, Rob.
Mike, before we hand it right off to you, I think it's important just for a second, and I'll stop sharing for a second. And Dave, I know you like this too. And Ken, who's our special guest sitting with Dave. I think what Rob, you just said is very important for everyone to understand and then deliver back to your team. Rob just said, knowing the rates is one thing, knowing how to deliver the message to your borrower, to your referral partners about where the rates are, where they're going and why, it's a whole different thing. And I just wanted to stop for a second to be like, when you're listening to Mike speak right now, don't just make this information you digest for yourself. Think about how you can turn this information into an advantage for you, right? Into an unfair advantage against everyone else that may not know this information, may not have this information, and may just be like, look, the rates are what they are. You should do a mortgage today, right? No. How do you take what Mike's about to share and go, hey, I'm going to arm my team with this information so they can talk to realtors, their other referral partners, their borrowers, and present really valuable, accurate knowledge back to the consumer to make the right decision. So just wanted to plant that seed in the way you should listen and the filter you should listen to this information from. It's not just self-information. How do you turn this back to your team and weaponize them? So I don't know if anyone had any thoughts, but I thought that was important to share. All right, cool. Getting some love. All right, back to you, Mike. I'm turning it on.
All right, thank you. I mean, let me just say, if we go to my first slide, that I think the education point is right on. Rob mentioned Wall Street Journal. I mean, I spent a lot of my life talking to reporters, and just even what I'm showing here on this picture often takes a pretty engaged conversation with the reporter to communicate what I'm trying to say here. So the blue line is the Fed funds rate. Everybody knows yesterday the FOMC raised their Fed funds target another 50 basis points to between 4.25 and 4.5. So the yield curve fully inverted now from the Fed funds rate out to a 30-year Treasury. If you look at the 2-year, it's about 4.25, 10 years at 340-ish today. So about an 80 basis point inversion between the 2-year and the 10-year. But what these reporters were asking, what a lot of your borrowers may ask is, okay, wait a second, why do you think we're past the peak in mortgage rates if the Fed says they're going to raise rates maybe 2 or 3 more times in 23? And so then you have to have a conversation about a yield curve and an inverted yield curve with the borrower or with the reporter. And it's a complex story that you're telling. So why is the Fed pushing short rates up today? It's because inflation, even though while it's coming down, is still at about 7% on an annual basis, and they wanted to get to 2. Why are long rates beginning to come down, even as the Fed is saying they're going to push short rates up further? It's that we think we're going to be in a recession next year. Many global investors think the same, and many investors now think the Fed has pushed short rates up so far that's going to really require them to bring rates back down. Maybe as soon as later in 23, we have it here showing sort of early in 24. So keep in mind, long-term rates are always forward-looking. The Fed is setting an overnight rate, and they're doing what they can to try to bring inflation down. So always uncertainty about a forecast. Why could this be wrong? If the inflation data we got from November, which showed a lower rate in November than we had in October, and we've had a couple of months of declines, if that were to reverse, rates will reverse as well. That really is the driver here. So that's phase one, what's going on in rates. Second, home prices. We had a couple of years in 20 and 21 of mid to high teen growth year over year in home prices nationally. That is coming down quickly. We were 12% as of third quarter. We think by end of 2023, that'll be a number like 0, and it'll be a small negative by the end of 24. You look at other forecasts out there, some are a little more bullish than this. You have I would say a larger number that are more pessimistic, looking for national home prices to fall 5 or as much as 10% next year. What's going to drive any of these forecasts to be accurate? Our forecast is going to be right if existing homeowners act as they're acting now. They're hesitant to list their properties. We're seeing a number of listings being pulled. So while demand is being crimped by higher mortgage rates, And by this pending recession and weakening in the job market, supply is also being pulled back just because people are not listing their homes into a weakening market. That's helped along by the fact that delinquencies are about as low as they've been in the last 40 years. So there's not a lot of distress out there. You are seeing builders offer some concessions to try to move properties, but even in the new home space, it's not a fire sale. It's just a little bit of help to get these properties moving. So if the situation changes, you get a whole lot of listings, we could see home prices drop more than I'm showing here. Right now, you look on the West Coast, some of the mountain states, you are seeing pretty significant home price drops in some of those markets, but that's really being offset by ongoing home price gains, particularly in the South, Southeast parts of the country. So, Alex, question?
Yeah. So are you saying, Mike, that if people start to list even more, like if more houses hit the market, the home prices are going to go down?
Yeah. So right now, demand has come down, but supply has been constrained for years. And the worry would be if all of a sudden people dump a lot of properties on the market, and that's not happening yet. The only reason that would happen is if you had a lot of people that had to sell today. But most owners are sitting on a big hunk of equity after the home price gains the past couple of years, and they just don't feel that need to move the property.
Interesting, because wouldn't you think that if you have a ton of equity in your home, this would be the time to move the property?
Alex,
Yeah,
can I interject?
please.
Alex, do you own your own home?
Yes.
Do you have a lot of equity in it?
Oh, yeah.
Why aren't you selling?
I just moved to this home 10 months ago. That would be the reason for me.
Well, that could be one reason. Another reason is where are you going to go? Even if you have a lot of equity, you're going to sell it and then move to I don't know. So it's I would say that a lot of the demographics point to I'm not in the camp that values are going to fall. The press, I like to make fun of the mainstream press in terms of, house prices going to plummet, yada, yada. And they have these sensationalist headlines. The fact remains, as Mike knows, we've got millions and millions and millions of people in their late 20s and 30s who do not own a home yet, who they don't want to be renters. Maybe some of them do, but a lot of them don't. They want to buy a home. And a lot of the baby boomers, Gen X, or whoever who are sitting on these homes aren't really in a big hurry to sell them because, where are they going to move? And so you do have a lot of equity there, but the fact remains that the demographics point to, a continued decent market out there. So I didn't mean to put you on the spot there in terms of.
No. I thought it was a perfect conversation, and I'll leave it at this, and then I'll turn my camera off and let Mike finish here. By the way, lots of conversations happening in chat. If anyone wants to take a look at that, and if anything we need to comment on. But my real point of saying that was to see if we can pull out some insight that the audience can go, oh, when this is happening in the market, I should be pushing the sale and purchase of a new property. I should be guiding my customers, my agents to be like, hey, let's get these people in the market, sell, let's get them moving forward. So I'm wondering, what is that instance that everyone on this call can wait for and go, oh, we're there. Start emailing, calling, texting our customers, telling them now is a better time to do that action that you've been waiting for. So that was my point of asking that question. And if Mike, you have any suggestions there, I'll just be quiet in the background here.
Yeah, I mean, I think totally agree with Rob's point that for current owners, lots of reasons why they might want to stay in place. Another, the lock-in effect that people talk about, that if they've got that 2 3/4 rate, that's a little more friction that they're not wanting to give that up to move. On the other hand, though, if you think back to your own life, right, often you're moving for non-financial reasons. People are getting married, people are getting divorced, people are having kids, people are switching jobs, and it may not be the best financial move at that time, but there's a reason to move. And so I think we're getting close to the point of the moves we're going to see are that's about the slowest pace of turnover we're going to see, because it's all driven by those non-financial reasons right now. But people still keep getting married, divorced, having kids, and switching jobs. So it continues to happen.
Right.
We can go to the next slide. Let's move to the mortgage context here. So, we've talked about 2020, 2021, biggest two origination years ever, north of 4 trillion. We've had about a 50% drop in volume from 21 to 22. So we think we'll end the year at about 2.2 trillion. And I know Rob gives us a hard time all the time, but we called this drop just about right. We didn't get 7% rates, but this level of decline in origination volume was what we were forecasting. We do think it's going to drop further next year. So we're now calling for about a 12% decline in total origination volume. It's about a 5% decline in purchase, another 28% drop in refi. Refi at that less than 500 billion level, that's primarily going to be cash outs at this point. Other than, Alex, what you said, it is going to be some, dare I call them, boomerang borrowers that got a 7% rate and are seeing an opportunity in 23 to refinance. So a little less than 2 trillion next year, sort of 2.3 to 2.5 trillion over the next couple of years in 24 and 25. So let me just put my last picture up, then we'll open up to the conversation, which is.
Wait, before we do that, Michael, I just want to ask about that last one. We've really been pushing lenders that, in this market, every lead, every loan, every basis point matters. I really think like turning on our cash out alerts and really making sure that you're monitoring your database for those opportunities is never been more important, especially, hearing that you think volume's going to go down. What are your thoughts on that?
Oh yeah, totally agree. And we might talk more about this later, but one trend that we've been watching, so if you look at outstanding credit card balances right now, you're seeing a lot of households stressed by the 11% increases in food prices, that at one point 30% increases in gas prices, just necessities of life, they're getting stretched. And that presents an opportunity in the next couple of years for maybe a debt consolidation loan that would come out of that cash out refinance. And I think there are going to be opportunities for lenders and borrowers on that point. The other thing I'd note here, we showed this 2 trillion-ish forecast for 23, and some of the lenders I talked to were like, wow, that's amazingly optimistic. 2 trillion still sounds like a lot of money. But if you look at the number of units this represents, there's about 13.5 million loans in 21, 6 million in 22, 5 million in 23. So that drop in unit count, that's the pain that people are feeling. There's just not a lot of business right now. Average loan size has increased so much because of the gains in home prices, but that unit count, I think, really tells the story better. So this
Michael, this has come up in a few of my interviews where I'm seeing loan officers get alerts where families' credit is going up, FICO score is going down, and it's a family in need. And so I think, to your point, guys, we also just need to be looking for folks where they're just, they're in pain, and we can be the first loan officer there to help them with it. So anyways, I don't want to slow you up. I know you got a few more slides here.
Well, I want to add on just real briefly that when people are making predictions to their bosses or their teams and thinking about further cost cutting, I know we led off with that poll question about, have you made the necessary changes in order to, prepare for 2023? It's not as if the changes are done. If you look at the MBA's projections and why not, further cuts might be warranted, or either that, or you're going to, swim out to the ocean away from the waves and try to get some more market share, or open up some new channels, such as a reverse channel, to take advantage of some of the demographics that are going on out there and get some more market share. So if you're just kind of stagnant and treading water, you're going to have to cut again and continue cutting based on the MBA's projections.
And then I guess my last chart is really just to add on to that, Rob, and also to add on to the comment that Alex made at the beginning that, these are tough times. It's not just the drop in volume. This is data from our quarterly performance report tracking profitability on the production side. So, averaged, 50 to 55 basis points. That's the gray line going back to 2008. 2020, 2021 were some really phenomenal years, both in terms of volume and profitability. But the last 2 quarters, negative at the industry level, and this is a sample of more than 300 IMBs. So -5 basis points in the second quarter, -19 in the third. So that lender's losing $600 or so per loan. And to the question that you asked, Rob, about have people made the adjustments, this is really where you're seeing that we're only sort of part way there. So we put out an estimate middle of this year, Marina Walsh, Joel Kahn, and I, that we thought sort of peak to trough industry employment was going to have to drop probably 25 to 30%. It's dropped about 10% thus far. That peak employment level was in late 21. We think the trough will be sometime early in 23. So obviously all the announcements people have made, the consolidation that's happening, making progress, but we can't be in a place where your typical lender is losing money on each loan that they're doing. So lots of ways to attack that. I'm gonna turn it over to you guys for the answers about how to get out of this challenge.
Yeah, you don't make up losses per loan by doing more volume.
Only on Saturday Night Live. Yeah.
It's a very tough spot to be.
Well, I do want to weigh in on this one just because and again, I am Mr. Mortgage Coach, but every time a lender has analyzed loan officers that use Mortgage Coach versus those that don't, it's at least 9 basis points more profitable. I'll show a couple numbers in a minute on that, but it's never been more important, to every leader that you're training your loan officers to deliver advice, deliver strategies, not price. If you create value for a consumer and you give them advice, they're more likely to do business with you the way you want them to do business with you. And so I think price exceptions, there's just a tremendous amount of waste that takes place, and a lot of profits could be gained by just getting your loan officers to deliver value and advice, not quote price. Because what we're hearing is price is going to get better, rates are going down, but it's still not great. It's still not a great price from a consumer's perspective through all of 2020.
Yeah, I agree 100%. I wanted to interject very quickly. Is there any truth to the rumor, Dave, that at the next conference you guys will be handing out Alex action dolls based on the photo that we're looking at on the screen here? Any truth at the booth?
We told you in the prep call that do not steal our thunder, please. Yeah. But yes, we do have a plan for something similar to that.
Yes. Tattoos and everything, by the way, the whole thing. It's going to be it's going to be perfect. Sorry. By the way, there's a question that I think it's worth commenting or at least addressing by Ken Bartley. He said, what is the negative effect on cash out refinances? And I don't know if I want to dive into it or answer it later. What is the negative effect on cash out refinances going forward with the new LLPA, when the new LLPA hits that go into effect in the few weeks? Mike, Dave, anyone want to, or is this too big of a thing to get into?
No, Mike, take it away.
Yeah, so if you look at the latest adjustments, they raised the LLPAs on higher credit score cash out borrowers, dropped them a little bit on lower credit score borrowers. And I think it speaks to what we were talking about, that your 740 credit score borrower, they got other options. They can go for a HELOC or a closed-end second. But for a borrower with the lower credit score, that may not be an option. And doing a cash out could be their best financial move. And so this actually seems like a sensible policy from that perspective. But I think the question is more, it's going to shut off some cash out refi business. And I think that will, just because the pricing makes it uneconomic. But what I described as the thinking behind it.
Got it. Love it.
Yeah,
go ahead.
I think, to follow up with Mike's point there, going back to me asking you, Alex, you own a house with a lot of equity. Why aren't you selling it? Well, here's why. If you put yourself in the shoes of that borrower or that loan officer who is looking at that program, and the loan level price adjustments have changed, of course, it's going to matter. Price is the fastest way to turn on or off a channel or a line of business or a program. And if you make it uneconomical for a borrower to do that, boom, it's like hitting a light switch. So the FHFA, I think, has done that.
So one more thing, and Mike, I would highly recommend you looking at chat because people are asking questions like, did Mike say that there were 21,000 units in 21 and we're only going to do and we've only done 6,000 in 22? Is that right? So just, you may want to answer some of those things because I think they're great questions. I'm sure others have that same question, but why don't I start sharing the screen because we have a great question on here and I really can't wait to hear from everyone on this. Here you go, Rob. Let me set this up for us. Yeah, go ahead.
Yeah, go ahead, Alex.
I just love this questions. Where do rates need to be in order for the move up market to get hot again? And I know, Dave, you have a lot of thoughts on this, and in general, you believe in the move up kind of methodology and conversations and knowing those things early. So any thoughts here, Mike or Dave or Rob?
I'll save my thoughts for my section in a minute. I'd love to hear, Rob or Mike on this.
Yep.
So I think in 23, we are going to see a larger share of the purchase market being taken up by first-time buyers. We talked about the lock-in effect. That obviously is only really applicable to move-up buyers. So we think more first-time buyers are going to hit the market. So that's more FHA business, more low down payment, more down payment assistance, more HFA-type loans. I think that's where the focus of the purchase market is going to be in 23. Our forecast is mortgage rates, I said, sort of 6.25 today. If they get to the low 5s next year, that'll free things up, right? But you're still going to have that borrower who got the 275. It's going to be some friction keeping them from moving.
Yeah, some folks are saying 5.25, 5.5 in the chat. So, I think it's worth noting that. But it's an important thing for everyone to pay attention to and look for in the coming market. So I think it's key to stay focused on there. Dave, we're moving on to you. I'm going to stop sharing. I know you want to grab the screen.
All right, guys. So I'm going to hit this in about 5 minutes. Feel free to chime in, add some commentary or questions. I'm going to share, from the interviews I do in the marketplace with top producers, what are the 4 strategies where, they're turning, advice into price. And affordability options is number 1. I mean, we are in an affordability crisis in America. We have a financial literacy crisis. And that's why this interview I did with Nicole Roth is so popular. We'll put a link to this. But it's really coming down to showing realtors and consumers options. Hey, here's a 2-1 buy down. Here's a permanent buy down. Here's a 7-year ARM. It's showing them options and ways of making the purchase of a home more affordable. So this is the number 1 strategy we're seeing. We're also seeing loan officers use this with realtors. Like this is an options strategy where Nicole went to a listing agent that, the home had been on the market for a month, smelled like a price reduction and said, hey, I've got some ideas and how different affordability options will help you sell the home and avoid a price reduction. So a lot better than a fee worksheet. Number 2 is the date the rate, marry the house. This is trending. I interviewed lots of loan officers on this, but to be able to show affordability options and then to be able to show, hey, this is what the MBA is saying. This is what Sir Michael is saying about rates. And then I think it's important, any loan officer or lender, guys, don't sell like, oh, rates are going to be this. We're here to, what do you think is going to happen, consumer? This is what some people are thinking. What are you thinking? And it's not here to push people into homes that they can't afford. You're there to give family options, and you're there to help them understand that, in the future, rates could be lower and you could have a lower payment, but you're locking in the purchase of your home. And then strategy 2, which I completely believe, divorce rent. Like your home ownership is a great investment, helping visualize that for the consumer. This is an actual first-year loan officer. This is 10th month in the business. Did $1 million in production the month before, but he's able to show renters like this is what owning a home looks like. We're seeing a lot of house hack strategies where either Airbnb a room. This is a scenario where it was a first-time home buyer who was single, and the loan officer was able to say, "Hey, if you rented out 2 of those rooms for $625, which is what the realtor said they could get, what would that look like if you invested that? So I think more than ever, we need to help consumers understand their options. And last but not least, I'm going to show and just make the point that when your loan officers are delivering advice and not price, they get less price exceptions. They're more profitable. I think, like I said, on average, when we've done these studies, we're talking 9 basis points more profitable if your loan officers are delivering strategies, and then the 4th strategy, and, any comments or questions, is just open houses. Open houses are back. Loan officers are going out there. They're supporting real estate agents with co-branded strategies. I really push every loan officer out there. Don't just show the property with a couple options, show mortgage strategies. That's why in our platform, we really help loan officers deliver more than just, hey, here's your rate, here's your payment, here's your cash to close. We're like, hey, here's this home, here's these strategies, and this is how they'll perform over time. So those are the hot takes from many of the interviews that I've been doing. And
hey,
Robert,
Dave, what was the third? Somebody asked, what was the third point?
The 3rd point was divorce rent.
That was number 2.
It's basically no, number 2 was date the rate. And
okay.
and remember, guys, this is recorded. This will be in the Mortgage Coach YouTube channel. And so check that out. And then
hold on, Dave. Can you wave your hands again back towards your face? No, back toward your face. It looks like the camera goes in and out based on your movement.
Rob, that is very astute of you.
It's not the mushrooms kicking in. It's really happening.
No, that's not happening, Rob. That's just too much Starbucks coffee today.
It looked like your camera was going in and out.
Well, before we miss the opportunity, guys, I'm sitting here with Ken Perry, the founder of the Knowledge Coop. He's been staying at my house a couple nights. I've been giving him fly fishing lessons in our swimming pool, but
we've caught nothing so far.
Yeah, I mean, so I'm not a very good. Anything you
dude? Look at all the love you're getting.
Do you think you want to call out?
Yeah, I can't get away from Ken Bartley's question because it was such a smart one. That adjustment to the LLPAs came out at MBA annual this year when FHFA was there, and it was an amazing announcement that, like, she brought. I felt like it was an Apple conference, but she brought all these amazing announcements, and I'm thinking, how few people are sitting here at the MBA conference taking this information in and know enough that there's changes happening in the industry that will affect you, and you have to plan for them. And when Ken said that, what about these LLPAs? The amount of comments of like, what are those and when does that happen? Like, you have to double down on knowledge right now, because that people need guidance and leadership, and those, being able to be the one that provides that and has your take on things, which is why I love that you're all on this call, because you're here to learn. And I think just double down on constant learning, because it's getting real weird, and you've got to get as many people giving you information as possible that you trust, and being better so you can plan a better future.
They're saying they can't see you. I think, Paul, I think that's something on your screen.
Yeah, I see Ken.
Did you see Ken just now?
I see Ken just fine. Just fine. Well, we've got about 9 minutes left.
And I want to cover 2 things, Rob, really quickly, because it came up in chat and I've been reading through it. 2 things: how will personal revolving debt impact the coming market, and are we partnering with banks and credit unions for HELOCs and helping offer things that we may be not able to do in house? So, can we get through those 2 questions in 9 minutes?
We can. This is a question for the group now, correct?
Yes. Yep. That's exactly right, for the group.
Well, Alex, you can answer this one. Why don't you take this one? Why don't you start?
Well, I don't know. Here, let me stop sharing so I can be on screen. I don't know if I can answer it as well as everyone else on this call could. My feeling is look, we've all seen the reports. More debt, more personal debt than ever. Okay, and obviously there's more equity in most places than ever. I think what is going to happen is consumers who are coming from this from one market to another are going to have lots of questions. We ourselves are still questioning things. We don't know. So they definitely don't know. And so you know who they turn to? We talked about this, Dave, on previous calls. They turn to the media. That's fear mongering. That's like giving some accurate information, mostly not as accurate as it needs to be, and just putting on their own spin on things for themselves to get people to listen to them. And so I think in this coming market, because of the amount of debt that's out there, I think what's going to be more important than ever is explaining the decision, not selling it, but literally walking people through the step-by-step of what it means for them to do something or not do something. Okay. That's what I think the impact of all of this, of all of these high debts is going to be, is your chance, the market's chance, the lender's chance to be like, look, let's slow this down. Let me make sure you understand the decision you're about to make or not make, and why it's good or bad to make that decision. So I think right now, the opportunity, the success lies with the lenders that embody the educational part of this. And you're going to see a very healthy 23, 24, 25 if you can educate and not just like sell on the news, because then you're going to be very quickly forgotten and hated on if what your advice was only good for you, not for your customers. So my opinion is those that can educate are going to dominate.
I have a question for the good doctor on that note. So the student debt that's out there, will students ever have to pay their loans back?
That continues to be a question, right? So there have been courts that have questioned whether the Biden administration planned to forgive that debt, whether that's legal or not. And so I think it's a bit of an open question. So it's another source of debt that may be a need for borrowers to consolidate. Again, I was pointing to credit card debt, because if you think if somebody has, $30,000 at 28%, a 6% rate looks pretty good if they can get that on a cash out.
Yeah, debt obviously is a very interesting topic, because I would have guessed entirely wrong. We have households across the nation saving tremendous amounts of money during COVID 2020, 21. I think the savings rate, Mike, went up to what, like 25% or some really just high savings rate. So as we've come off COVID, the balance sheets of households are really, the balance sheets are in very, very fine shape. So I wouldn't have guessed that revolving debt would be going up, given how much families were able to save during the pandemic. So it obviously factors into the underwriting decision. And I know that a lot of families came out of the pandemic thinking, well, we're going to go to Disney World, we're going to go to Disneyland, we're going to start spending, we're going to, start buying clothes again or buying cars again or whatever it might be. So that is going on, but really the revolving debt, ask any underwriter about, how that looks on during the underwriting process. And it can be a problem. It can be, detrimental, significantly detrimental to a borrower.
And
Angela, I love your comment. I'm going to put a few words to it. She said, those who educate will be able to dominate. So, it really is.
There's too much rhyming going on in this session. I think Dave, you let off your thing with like turn advice into price, or maybe it was turn price into advice or something. And now educate, dominate. Anyway, Alex, what was the darn next question? As we only got a few minutes left.
Think of these things, Rob. You love to rhyme. Next question, Alex.
Yes. Okay. So, and we won't even do this poll. I mean, let's just talk about it, so not have to get everyone to click in. For those of you listening and not watching the screen, the question is partnering with a bank or credit union for your ARMs going to be a great strategy? ARMs, HELOCs, things like that, going to be a great strategy in 23. I want to open this up to this group and not ask the poll question. What I would like you guys as an audience, honestly, if we could send you all awards, we would. This is the most active audience we've ever seen. I want to hear from you guys in chat, and let's see if we can grab some of those comments and bring them into the conversation. But I really want to hear from you, Dave, and actually the Rob and Mike on this too. Like, what do you think? Is this healthy? I'll give you a quick story. I spoke to a very large consumer direct group like 5 months ago, 4 or 5 months ago, and they had already implemented then the relationship, knowing that they're going to want to offer HELOCs and they're going to want to offer ARMs and have good partners to refer people to. They did this months ago and are actually feeling the positive impact of it. But is it for everyone? Why would somebody do it? What's the risk? What are some thoughts?
Let me just throw out a data point. In our weekly application survey, we track ARM rates and fixed rates. Last couple of months, the ARM rate for a 5-year initial fixed period is about 100 basis points below the fixed rate. So that is meaningful to a borrower. And I can tell you that is coming from depositories, not from a securitization execution. And so I think having those kind of relationships can be really beneficial.
And by the way, just so you know, if you're not looking at the audience, so far, everyone has said yes, 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 except for one person who said no, no. So right now, people are leaning towards the yes. I think what you just mentioned, Mike, again, supports the yes. Dave or Rob, what are you guys thinking?
So
Ken, I'd love to hear from you.
I'm sitting here thinking I need to take the no stance just to play the devil's advocate. Early in 2022, the difference between ARM prices and intermediate ARM rates and 30-year rates was much more dramatic than it is now. We had a steeper yield curve, and the yield curve, if you look at the twos, the 2-year rates right now are higher than the 10-year rates and the risk-free treasury yield curve. That is reflected to some extent in mortgage rates. The bloom is off the rose to some extent with 3-1, 5-1, and 7-1 product. There still is a difference in rate, but it's not as much as it was. And so I harken back to my early days in capital markets. I mean, one of my jobs was trying to find investors who would buy our ARM loans. And that's part of any good capital market staff, is to try to find investors. If you're a large company, though, you may find a smaller investor. You don't want to swamp the investor's boat with, hey, we've got 80 branches who are going to be sending you 3-1s and 5-1s and 7-1s, because a smaller institution or credit union can't handle that. So it's always good to have options from a capital markets perspective, whether it's selling loans to Fannie Mae or Freddie Mac, or delivering them to smaller depositories. It's always good to have those options. So I wouldn't say that 2023 is any different than any other year in terms of being able to foster those relationships and have them in place for a rainy day.
Rob, I found one person that really thinks you're smart and they agree with you.
My parole officer?
Yes. He just texted me, said, by the way, you're late to wherever you're supposed to be.
Right. The ankle bracelet's going off down.
It's vibrating.
So my comment on this is, I just want to remind everybody, don't sell products, sell how you solve the problems of the consumer, and make sure that we're really asking the consumer, what their goals are, and we're giving them options. So, our ARMs, nice to have in the bag, it's like a golfer. Yeah, we want all the clubs in the bag, but we don't use all the clubs on every hole. And I think too often the biggest problem in the mortgage industry is that, I sell 30-year fixed rates at X points or no points. And, loan officers and lenders, focus on selling products. And I think to win in 2023, we need to, understand the need of that consumer. And then we need to provide them with options to win. And we also need to teach realtors to do this, quit selling your favorite price or your favorite lender. Of course, if it's a MortgageCoach lender, you want to sell that lender because they're going to give advice, not price. I know you love that quote, Rob. I just had to close.
I know. That was a great way to end the session, Dave. Great closing words there. But I thought I would, as for the last 15 seconds, since we are already over time, turn it over to Alex. And Alex, do you have any closing comments that you'd like to say?
Yeah, at first I'd like to say, Candace just pointed you out, Rob, in a recent podcast that was highlighting HELOCs that you just did. So maybe there's something we can add to the video as we send it out to everyone. Maybe we can include that podcast. in that, because that would be interesting for people to see. I mean, look, my closing remarks is, first of all, what an amazing group of people, great panel, what an amazing audience that's participating, giving us hearts, and look, we do this to give you all the confidence to go into any market, any situation, and be able to add value there. And that's what we put these on for. And having Mike and Rob and Dave and Ken here, I hope you all received extreme value. We answered your many questions in chat. You guys have been phenomenal in being participants. And so look, go into next year armed with the information from this session, get the confidence, get your team to rally behind the things that you're doing and why you're doing them. Don't forget to tell your team the why behind these things. Perfect. Thank you, Dave, for throwing this up. It's just been a magical experience this last hour with all the feedback and all the commentary and the hilarity from you, Rob, and Mike and Dave and everyone. So loved the session. I hope everyone else did. Please show some hearts, some love, some thumbs up and everything if you loved it. And I'll hand it off to you guys to close out your thoughts.
Mike?
Thanks for the opportunity. Great to talk with you guys. Looking
Yeah.
forward to seeing everybody in the new year.
Yep.
And my
Hopefully,
my-
hopefully
Go
the
ahead,
San
Rob.
Diego IMB.
All right, guys. And if you want to learn more about Sales Boomerang Mortgage Coach, we would love to do that. Either go to our website or take a picture, and we'll talk to you soon. Have a great
And
day.
Dave, don't we have some really big news in February coming?
We do. We've got a big announcement in February. Stay tuned. And
That's right.
thank you very much, Rob and Mike. Really appreciate both of you
Thank
and
you,
your
guys.
service.
Truly.
All right, guys. Thank you.